My piece over the weekend was called Cut Taxes and Cast the Tax Net Wider and Avoid Being Hambantota-ed. Last week, the big headline event was the synchronized release by EAC Finance Ministers of their individual budgets for the full year 2018-2019 beginning July the 1st. According to the budget numbers presented, Kenya's budget is twice the size of Tanzania, and bigger than Tanzania, Uganda, and Rwanda combined. Kenya and Tanzania and Uganda plan to borrow more than $12 billion to plug budget deficits. In the new financial year, Kenya has a deficit of $5.58 billion, Tanzania $4.6 billion, and Uganda $2.4 billion. Under this fiscal consolidation plan, we project the fiscal deficit to narrow to 5.7% of GDP in the full year 2018-2019 from the estimated 7.2% of GDP in the full year 2017-2018 and further to around 3% of GDP by full year 21-22. As such, this will help stabilize the net present value of debt to GDP ratio below 50%, which is well below the 74% threshold considered to signal an unsustainable debt position. That's the Cabinet Secretary. Genghis Capital said it expected Nairobi's interest payments in the 2018-2019 fiscal year to grow by 31.11% to 3.9 billion, while redemptions will increase 36.7% to 4.7 billion. The Ugandan Finance Minister Matia Kasache said our ratio of public debt to GDP now stands at 38.1% in nominal terms, which is much lower than the threshold of 50%, beyond which public debt becomes unsustainable. There is self-evidently a difference of opinion between ourselves and the Ugandans about what is a sustainable debt position. Interestingly, Tanzania presented the most fiscally conservative budget and is reducing corporate income tax for new companies to 20% from 30% for their first 3 years of operation to encourage investment. At a macro level, what is clear is that the EAC countries have embarked on a debt-fueled investment binge, and the sustainability of the debt will be decided by the return on investment of the investments made. This point will come into sharper relief as the US continues to dial up US interest rates and reduce the extraordinary stimulus. Emerging markets have been pounded of late, currencies have been crashing from Turkey to Argentina, and President Kenyatta seems seized of the direction of travel, going by the generosity of his welcome of the IMF's Lagarde at the G7. Therefore, the go-go days where you just stuck up your hand and asked for $500 million and got $2 billion are behind us, and it's high time our policymakers got with the program. Prime Minister Abiy Ahmed of Ethiopia has read the writing on the wall, and hence his economic pivot, which caught his own party and the rest of the world off guard. In these moments, being ahead of the curve pays exponential dividends, and the mercurial Abiy is delivering on all fronts. I think he saw very clearly how Sri Lanka got Hambantota-ed. Sri Lanka borrowed billions from China to build a port, the Hambantota port. It is a white elephant, a vanity project, and China, Sri Lanka's creditor, has taken it back on a 99-year lease. So the first overarching point is that creditors are not Santa Claus, and miscues will exact a very heavy price. Countries will be Hambantota-ed. Now, if you look at all the budgets, the common thread running through all of them is the size of the recurrent expenditure, which dwarfs everything else. Therefore, taxpayers have to ask ourselves, are we getting value for money? The situation reminds me of a time before Uber. Today, my taxi fares are about 1/3 of what it cost me pre-Uber. The question is therefore, how do we Uberize government? How do we Kodak the existing structure and move to an Uber future? I have no doubt that we could take 2/3 of the cost out of the recurrent expenditure. Again, we need to get ahead of this curve. If we don't get ahead of this curve, our creditors will. Let me finish off with Kenya Inc. CS Rotich announced plans to repeal a law that caps commercial interest rates. The rate cap law has seen private sector credit growth crash from around 20% to close to zero. The SME sector, which has had to bear the brunt of the private credit growth slump and is the engine room of our economy, needs credit like a shot in the arm. CS Rotich dialed up excise duty on mobile money transfers by 2% and introduced a Robin Hood tax for transfers above 500,000 shillings. He projected tax revenues to rise by 17.5% to 1.9 trillion Kenya shillings, equivalent to 20% of GDP. A year-on-year increase of 17.5% in the tax take is a bold call. Existing taxpayers have been squeezed until the pips are squeaking. This is now a zero-sum game. In order to get the show back on the road and to get back to faster GDP growth, because growth is a silver bullet, we should be cutting taxes and casting the tax net wider.